This episode is sponsored by Interactive Brokers. And are you ready to take control of your financial future? Meet Portfolio Analyst from Interactive Brokers, the free all-in-one dashboard that lets you consolidate, track, and analyze all your financial accounts in one place. You don't need an IBKR account to use it. Just connect your accounts and see your complete financial picture, your investments, performance, and allocation all on a single screen. Plus, you can plan smarter with IBKR's new tax and retirement planners, built around your goals and your market assumptions. Get deep portfolio insights with detailed risk assessments and compare performance against more than 300 benchmarks. Plus, manage with confidence thanks to GIP's verified returns. Ready to get started? Sign up for a portfolio analyst, which is free for everyone, at ibkr.com/free PA. Interactive Brokers, the best informed investors. Choose IBKR. Member SIPC.
The Disciplined Investor is all about you, your money, and the markets. Sit back and get ready for this edition of the Disciplined Investor Podcast.
This episode of The Disciplined Investor is sponsored by Horowitz & Company. If you're looking for a portfolio manager, look no further. Horowitz & Company. From seed through harvest, cultivating financial success.
We got Swiss cheese agreements. Overspending by big tech. That could be their downfall. A rate cut in the dark. And our guest today's Vitaliy Katsenelson discussing hopefully some basic math of this market and find out what's going on with valuation. Maybe even find some bargains. All this and much more on episode number 945 of the Disciplined Investor Podcast. Hey, it's November. Welcome to the fun part of the year. It's kind of like a basketball game, where the last few minutes are the only thing that really matters. The last 2-3 minutes of a basketball game, it's like, okay, it's tied up. It's within 3 points. It's been 5 points. It lasts forever. And that's kind of like what happens towards the end of the year. We have that seasonality that's all important. It's not exactly like the last 2 minutes of a basketball game, I'll give you that. But the seasonality and the importance of the last couple of months of the year, in particular over the last, a couple of decades, as we get closer and closer to that end of year holiday season, the seasonality that we see when things pick up. But this year could be something to watch, something different. And I'll tell you why. You have a consumer that is stressed. Nothing really terrible on the whole when you look at sentiment, when you look at the totality of retail sales, when you look at it from afar. But when you start digging down, looking into the details of what's going on, there's some real problems. There's some cracks in the armor. And it's a real serious concern. The lower end of the income spectrum and their ability to spend, listen, they're just tapped out. They're exhausted. The ability for them to come up with more money in the face of goods costing so much. You may say, what do you mean? We don't got much inflation. We're being told that there's not a lot of inflation. We're coming down. In fact, I heard a few politicians recently say that inflation has been coming down and down and down. Things are looking a lot better. And yeah. Inflation has not run away like it was 8, 9, or 10%. But the fact is it's at 3%. 3%, which is 1% higher than what the Fed is looking for to begin with. We still have an inflationary market. And somehow, I don't know how, which we'll talk about in a second, the Fed in the dark without economic inputs cut rates. The 3% inflation that we see is on top of the 4%, the 5%, the 8% that we saw a few years ago. The compounding effect of that on prices is monumental. The ability for individuals to absorb that is becoming too much. Their pay, their salaries, their overall compensation is not keeping up. That being the case, you have to wonder what's going to break. How is this going to all play out? And why are the markets continually making new highs after new highs? Yes, there was a little bit of backup here, but I'm saying generally speaking, when we look at where things are, the multitude of years and the multiplication factor, the compounding of the inflationary environment on prices is clearly adding up. And again, The politicians are saying, hey, inflation's coming down under Trump. It's great, what we've seen lately. And yes, inflation has come down over the last few years, but that's not who we look for to find our data. If you're looking at one station, CNN or Fox, if you're listening for politicians to tell you exactly what's going on, that is not the way that we look at data. Because it's twisted and it's meant to be either looked at in an unfavorable fashion or a favorable fashion to benefit whoever is speaking. There's an age-old question that's asked. How do you know when a politician is lying? Well, when their lips move. Right? I mean, the politicians of today, unfortunately, have a lot of... They're really more concerned about their own individual stature and their continuation of being able to be elected than they are on telling us what's really going on. Now, we know that there has to be, and this is something that I've said many times, that we know that the Fed is a cheerleader, but they have to be. That is their job. You can't take that away from them. But we got to look beneath the surface and understand what is actually going on because it's our money that's on the line, not theirs. Don't forget, the government's closed, 33 days? The senators, the Congress people, they're getting paid. They're not skipping a beat. Now, the Fed came out this week and they dropped rates by 25 basis points, right? 0.25%. They also announced an end to the balance sheet runoff starting in December. In other words, they're about to start buying bonds again. We call that, right? That's quantitative easing. That's what we call it. And during their recent, that was Wednesday, during their recent presser, 2:00 was the rate announcement. We all knew that it was pretty much baked in stone that we would get this 25 basis point reduction. And there was some talk about kind of greasing the skids into the actual meeting that they talked about that probably we're going to start slowing down on the bond runoff. So we knew that was going to happen there too. But they were really cagey. When I say they, it was Chairman Powell, was a bit cagey about the next possible rate cut. Talking about how, December, we'll see what happens. Because they, of course, are data dependent. The December rate cut odds have gone from 81% to 72%. So there's still a general feeling that the Fed is going to continue cutting. But as of right at this exact moment, and I don't think this is going to last forever, but right now, right where we are at this day right now, they're doing this totally blind, in the dark. The Fed, who is supposed to be this data-dependent organization, they keep on touting it as we are data-dependent. They cut rates without knowing all the data. And the data that they do know, which is CPI, is climbing, or at least steady at 3%, above their target. The data they don't know is about employment. In fact, rates went up after the meeting. After the rate cut, we saw the 10-year actually go up. Now we know about the Fed. This particular meeting in itself explained to us and taught us a really good lesson. If we didn't know before, we know they're full of shit. We know that they don't have all the data to make a well-informed decision, yet they cut rates and spent 90 minutes trying to explain their logic and their potential next move. We saw that one of the characters that was recently appointed wanted a 50 basis point cut without knowledge of all the data. We know it's all a bunch of BS. The environment that we live in, that we're all supposed to believe without asking any questions, right? The China deal. Oh, the China deal. What a crock. China's done it again. They outplayed us just like the last time. I remember sitting right in front of a microphone just like this on a podcast some time ago, talking to you about exactly what I'm going to tell you right now. They know how to work this team, and it's eerily similar to what we saw during Trump's first term. These so-called deals, right? The announcement of these deals. We got a deal. The best deal ever. Oh my God, an excellent deal. Perfect deal. They're much more optics than substance. President Trump seems to be really desperate for whatever reason. I don't understand the psychology about this. I really don't. I mean, I could speculate, but I don't really get it. But this unbelievable need to prove something. But what are we getting? We're not getting deals. We're getting these Swiss cheese agreements full of holes, just like the Trump golf course. Full of holes, just like any golf course. That's what these agreements are. They're not deals. This is a masterclass in negotiation from China. And a reminder that, the headlines themselves, they don't always equal progress on a particular area. And what do we get out of this deal anyway? Well, China got lower tariffs. We know that. We may have received some soybean purchase. Good for Scott Bessent, who seems to be a soybean farmer of sorts. He admitted that last week. They're going to be buying some soybeans. Woohoo! Woo! They're allowing the rare earth sales back to the U.S. You know what that is? That's just back to where we started when Trump took office. This is a chess game. China did a great block by adding the rare earths. We hiccuped by putting on those tariffs over the weekend that came off. Remember that whole thing? The 100% tariffs on China that's going to come. That came off. That disallowed us from doing anything because they put a great block there on our check. And then they came in for the checkmate. That basically allowed them to say, you know what, you want to do a deal? No, I don't think so. Yeah, the tariffs and all that, that's great. You need these rare earths, just to be clear. We'll buy some soybeans, good for us, we don't care. You lowered the fentanyl taxes, that's great. So I'm getting more and more skeptical about the backdrop and a bit more concerned of how investors are taking on this whole idea. And then more importantly, what we saw late in the week last week was the reports from the Metas, the Microsofts, et cetera, the hyperscalers, if you will, or the AI spenders. And let's forget about this whole vendor financing concern, but the actual massive CapEx. I mean, Meta, during that conference call, was like, what? How much are you going to spend? This is like what Mark Zuckerberg did during his quest to dominate the alternative reality, or the when he was building the glasses. No, the glasses. I got one in my closet. The Oculus, right? When he was doing can't remember the words for it. When he was building out that whole thing where it was going to be, nobody's going to be in meetings anymore and everybody's going to be basically in, online in this virtual reality. That's what it was, virtual reality. This virtual reality setup. And everybody's like, no, I don't think so. Well, investors gave the nudge to Zuckerberg last week and the end of the week after the earnings came out, and particularly when they came out with their conference call with how much they were spending. It's like, you know what? Hey, maybe going a little bit far. Maybe this spending bender is going to, make investors not as happy. And OpenAI came out last week with a restructuring. Microsoft now owns 27% of that deal. Now OpenAI is looking to do an IPO with $1 trillion of valuation. But wait a second. Hold on. Don't they have plans and commitments and promises already for payments over the next few years for that number? And if Microsoft owns a big piece of that, even though the valuation is $1 trillion, they're not getting $1 trillion in. Maybe a few hundred million, billion. But you got commitments to pay hundreds and hundreds and hundreds of billions to Oracle and this company and that company. And where's that money coming from? So many questions. So little time. That's what's happening. I mean, I got to tell you, I'm going to be watching this very carefully. We did cut down some of our positioning and do some real rebalancing of portfolios over the last few weeks because my concern is being raised with the current valuations. Look at the Case Shiller, the Cape Index, and it just the amount above where the ratio is right now is getting a little spooky. The fact that investors are just throwing money at everything, it's getting a little concerning. I've seen this movie before. And by the way, it doesn't have to end in a crash and all that, but it needs to settle out. So we're waiting and being patient in some areas. I'm going to get to our guest. Before we do so, I want to talk one more time about Interactive Brokers and ask you a question, something to think about. Here it is. Will the U.S. Fed funds target rate be above 3.625% at the FOMC meeting ending December 10th, 2025? At IBKR Forecast Trader, the yes was recently at 23% and the no was at 75%. With Interactive Brokers forecast contracts, you could trade on future events like climate change, the economy, politics. You simply choose yes or no. And if you're right, you get paid. It's that easy. Explore the data, spot the trends, and make your prediction. Trade forecast contracts at Interactive Brokers and earn $1 for every correct prediction. Now, forecast contracts are not for everybody. They're not suitable for all investors. Go make your prediction. Go to ibkr.com/forecast and start predicting today. The last trading day for this contract we talked about, December 10th, 2025. All right, so let's get to our guest, Vitaliy Katsenelson. He's been on many times. Great guy, good friend for many, many, many years. He's Chief Investment Officer at Investment Management Associates, a value investment firm based in Denver, Colorado. After he received his graduate and undergraduate degree in finance, cum laude, from the University of Colorado at Denver, he finished his CFA designation, and he wanted to keep learning. He does teaching, he writes, he invests. Lots of things I want to talk about, some of his recent writings, some of his recent ideas, and talk about valuations because he's a value guy, so he really gets into the fundamentals. So something we really, I think, need to focus on right now. So let's get right to that discussion. So Vitaliy, it's been a while. How are you?
Andrew, I'm doing great. It's so delighted to be on your
I'm always happy.
Podcast.
Always happy that you're here. How's your son, by the way? Last time I saw him, you and I were walking for miles and miles and miles, like a lot more miles than I thought we were going to walk, down a strip on the beach down in Miami.
That's right. So listen, my son graduated from CU Boulder. He had a job in corporate finance for a company here locally for a while, and didn't like it there, and decided he wants to join IMA, and now he is running our marketing.
Oh, very nice.
So it's like the way I explain it to people. So he does marketing, so I don't have to.
Ah, I like that. Well, it's also you set up a succession plan in a way.
To some degree, I mean, he has very little interest in investing, but he learns how to how the company how the company works, etc. So if he decides he wants to stick around, he may become a CEO or something.
It's always good. You can have lunch with him whenever you want.
You know what? Every time I come to work, I kind of pinch myself. I get to spend time. First of all, I have a great team here, but I just kind of get to spend time with my son, and just it's phenomenal.
Great. Yeah. So let's talk about your time, because I read this article you wrote recently about Amazon, which actually is an amazing company. We know we all know them and love them, but you had the experience of spending time actually in a warehouse and the light and the dark side, and then talking about how they do things and what they do, and you were just blown away.
Yeah. So I went to visit one of their distribution centers in Denver. And it's about 2 million square feet. Think about maybe the size of it's on 3 stories, about 2 million square feet, the size of maybe 40 or 50 football fields kind of thing altogether. And when we showed up there, what really blew me away is this. Imagine you have this kind of this area where on the perimeter of this, you have almost like a track. And this is where people walk. This is where the goods are being delivered. And then 2/3 of the warehouse is dark, completely dark. And then 1/3 is lit up. And the dark part is basically fenced up. And this is where inventory lives. But inventory lives there on the shelves that's been basically transported around by these robots that look like lawnmowers. So you have this lawnmower kind of slide under the shelf, lift it up, and bring it up to this area, what I call a DMZ zone, where the lightness and darkness kind of meet. And on the DMZ zone, you basically have hundreds of stations where you have people taking stuff from that shelf and putting it into bins. But what's important to understand is, like, if you pay attention close enough, you realize these people there, they just look at the screen, and the screen says, on the row 5 to the right, pick up this item, and it has a picture of it. Pick it up and put it in the bin 2. They do this, the computer counts how many seconds it took them to do this, and then the next instruction comes in. And I watched it, and I realized people who are doing this are almost like middleware. They're like, it's kind of as good as the most, like, what they were doing was completely mindless. And if you spend enough time looking at this distribution center, you realize these people come to work for 10 hours a day for 4 days a week, and the job they're doing is basically incredibly robotic. There is a single thought goes into what they're doing, and I had these complex feelings. And so then the whole distribution center is basically run by a computer. It's already run by the overlord of computer. In a sense, the second you order the package, the algorithm decides what's going to happen, makes millions of decisions to which shelf to bring to which person.
And the interesting thing you saw, though, I have two things I want to talk about. I want to talk about light and dark, so remind me about that. But there is no like A, B, C, D, E, F, G. There's a randomness. The particular product could be on any shelf anywhere, but it's known by the inventory system where all that is. Like an individual would not able, if you were an individual going into that sector, the dark sector, we turn the lights on, for example, and you'd be like, where is it? There's no rhyme or reason. You could have paper next to perfume, next to soccer balls.
No, absolutely. So there's the 10,000 shelves that are randomly standing kind of on the floor, and the computer knows where every shelf is, and computer knows where every single item is there as well. And the reason I'm kind of drawing the dark and light comparison is because computers, the robots, don't need light. This is why 2/3 of the warehouse is dark. And it's the light part where humans are. But the interesting part is this. Like, I was after the tour, I was talking to my colleague, and I said, this whole dark section looks dystopian. And my colleague said, no, Vitaliy, it's the human part that looks dystopian. And the reason the human part looks dystopian because even though there was light, but the job the people were doing, they were basically following directions by algorithm, what algorithm told them to do. And the IQ in that distribution center lied completely in the algorithm. Algorithm made every single decision there. And so when I left the distribution center, I had these complex thoughts. That distribution center employed 3,100 people. And I can see that in 5 or 10 years, that whole distribution center will go dark. It's going to have maybe 100 people just dealing with edge cases and maybe turning on the lights and turning off the lights. I don't know, actually. There will be no light switches.
The point of the lights, by the way, is not an issue of whatever. It's just they don't need them on. There's no reason to have them on. That's the point.
Exactly.
Yeah.
Exactly. No, that's exactly right. But then I realized, okay, so 3,000 people will lose those jobs.
Yep.
But also on one side, you kind of feel sad about this. But then you realize, my God, I'm not sure I would want my kids to have those jobs.
Right.
I'm not sure, because that is a job. What you have to understand is this: if let's say you work at Walmart or Target or whatever, you at least see people and you socialize with people and you have interaction with people. Here, you are basically in this warehouse where you're wearing headphones because it's too loud for 10 hours a day, and all you're doing is just following the instructions computer tells you to do, and you have almost no human interaction at all.
Yeah, but I think you're being too nice, my friend. There are some people that is the job that there really is appropriate for them. There are people that are ticket takers at the toll booth for years. I think about that all the time. Like, oh my God, could I imagine being stuck in that toll booth for hours and hours and hours? The bridge tender. How about the bridge tender? All he does is talk on the radio. Please open. Okay, we're opening. We're closing. Okay. I'm just saying this. What is? But the point is that hopefully, if there's an upshot here, the upshot is that maybe the machines will take over and then give the opportunity to that person to actually do something that may be much more, if that was suited, but something that is much more rewarding.
You hope so. So this is why I had complex thoughts, right? Because on one side, I'm not sure. Maybe you're right. Maybe some people like to have those jobs, like actually want to do this.
Right.
Maybe
there's definitely people that like mindless work.
For me, people in my epic circle would be crushed if they had to do the job. Okay.
Yeah, I get it.
But maybe you're right. But and you're right about that. And those jobs. But here's the interesting part. A few weeks ago, CEO of Walmart came out and said, despite us opening new stores, we're going to basically put freeze on hiring people in the warehouses.
Yeah.
And I can see, then a week later, Amazon came out. Actually, maybe last week, I think they came out and said they're going to be laying off 14,000 people, and those actually white collar jobs.
Right. I think 30,000 in total.
Oh, is that? Yeah. Okay.
30,000 in total, 14,000 or something like that was in management or something that they overhired for.
I have a lot of conflicted thoughts on this. In the past, if you and I talked about, so this is like this distribution center is the version 9, and so this is like, and maybe it's 6 or 7 years old, and there is already version 13 that's even more automated than what I saw. But Andrew, 5 years from now, 10 years from now, these distribution centers will have very few people. It's just going to be computers doing all the work, the robots doing all the work. And I was thinking a lot about AI, because when we were thinking about in the past about AI, this is what we were thinking about, right? Is this kind of mindless jobs being gone, okay? Kind of automation of, but what we start seeing is that, the AI is actually now going after white collar jobs as well. And those are much higher paying jobs. So in the past, when people ask me what I thought about the impact of AI on the economy, the argument I would make was very simple. I said, listen, 100 years ago, 40% of the country worked on the farms. Mm-hmm. Okay. Then after automation, after the development of combines and automation, those, today we have maybe 2 or 3% of people working on the farms, and we produce a lot more and export a lot more. And so, but those people went to work on car factories. They were doing jobs that did not even exist 10 years ago, like search engine, I don't know, SEO, like software engineer did not exist.
These things weren't exist. Yeah, I get you. Right, sure.
Yeah, exactly. So the job, but what I think is different this time is AI, is that I think the speed is so much faster, and it's so much more pervasive across so many sectors. It's so much more horizontal. It impacts everything. And that's really introduced a lot of uncertainty. And
well, right now we're riding the high. Right now we're riding the high of the expectation and how much more productivity it's going to provide. Because you got to admit that the Amazon, what's an amazing thing about Amazon, the company, the book company that was originally started with Jeff Bezos back in the 1990s, was that everybody thought it was going to fail because they were a book company. And by the way, if they remained a book company, they probably would have failed. Just a book delivery company. Yeah. Even though there's some Barnes & Noble still hanging around out there. But the fact of the matter is that they saw the opportunity in what they were doing back then, in that they needed this machinery and this AWS style at the time, the web services, to do what they did. And they said, wait a minute, this is fantastic. And the same thing is happening with the distribution, where they created not only great distribution, but state of the art stuff that allows them. I mean, it is pretty unbelievable that I click a button in Amazon, it says it'll be there in 4 hours. You know, is it unbelievable? Like, well, that's no big deal. You can always get food delivery in an hour. Fresh food delivery. But, you can find some obscure product, and the worst it's going to be is maybe a day or two later.
Yeah.
And we had to refocus on how we did things in life, because the old days was like, I'm going shopping. I need this stuff. I need it now. We didn't want to wait 3 days, 4 days, 5 days, right? But we changed ourselves on how we do things with recognition of, you know what, I need ink. Let me think through this. I'm going to buy some ink for my inkjets, or I know I'm going to need, I don't know what it is, right? This particular thing, a vitamin. Let me buy it now. Be here in a few days, and I'm stacked. I got my inventory is back to where I need it to be. We've changed how we do things to adapt to how they do things, and Amazon is premier in this area.
No, absolutely. But I think the point I'm trying to make is that Amazon is just one example. And I think this is going to become a standard practice across most companies.
Yeah.
And the ones that aren't will not be around.
But let's talk about AI for a second, because you touched on that. Yeah. And let's talk about, there are plenty of careers, businesses, jobs that are not going to be in existence. I'll give you an example of something. We talked offline about a recent trip. I was in Italy. I was in a place called Orvieto, and I was standing in front of this beautiful church, and I was looking from the outside of this beautiful church, and it was this big dome. It was like a Duomo in Orvieto, and I'm looking at the front of it, and there was 12 different statues in the front and this fresco, and it was this beautiful edifice, right? And I said out loud, I wish there was somebody who could explain this to me. I popped on my Microsoft Copilot, and I said, I'm standing directly in front of the Duomo in Orvieto. I'm looking at these 12 statues. Are those representation of the 12 apostles? And tell me about the fresco and the design. Okay, Andrew, and started rattling off this unbelievable conversation with me about each of the different parts of the front edifice, if you will, of the church. And I said, all right, well, now I'm about to walk in. Tell me about what's important inside this church, which I should be looking at. And there was a certain particular immaculate something, that there was a statue that started bleeding back in whatever day that was considered this holy thing. And, it's over on the left side. And you talk about the fact that a personal travel guide is no longer going to be needed.
Incredible. No,
and the people I was with, by the way, had no experience with AI, and they were just totally flabbergasted.
Yeah. It's almost, they felt like they just visited the future.
Right. Exactly.
Which they have.
Yeah.
Which they have. Yeah.
So AI, there's a promise, there's a hope, but there's also a reality check too, isn't there? I mean, there's a lot of components.
So the way I look at this, I kind of draw a parallel between AI and .com bubble, but let me just, the internet, but there is the nuances. These parallels are never perfect, but there are certain things that are kind of similar. And so a couple things. Number one, the internet was supposed to change the world, and it has. It has had, right? It has incredible impact on us. But in the short term, I would argue the impact was less than expected. And then in the long term, impact was much greater than we expected ever. So it just takes time for those things to play out. And we get over optimistic in the short term and probably don't underestimate the impact in the long run. That's number one. Number two, another thing is that the inflection point with internet came in 2007, 8, or maybe 9, I forget, 8. With the introduction of iPhone. Mobile phones have changed the trajectory, kind of the slope of internet adoption and its pervasiveness. So that's one analogy, and we'll kind of merge them together in a second. Another analogy is that during the .com bubble, there were a lot of companies that kind of were kind of vaporware, and that's not what we're seeing today. but there were a group of companies that were actually made internet possible. And they were the fiber optics companies.
Right, the backbones.
It's it's the Quest Communication, it's Level 3, Global Crossings, and a few others. And at the time, I remember how Level 3 was saying that they just cannot build enough capacity for internet because the demand is going to be so huge. Now, as the demand ended up being huge, but with a couple of things that happened at the same time, that number one, they were not the only one building that fiber. There were other companies doing it as well. And number one. Number two, what also changed, technology has changed. The compression made, even though we use, exponentially more data today than we did 20 years ago, the technology changed and now data is a lot more compressed. So how that brings us to AI is this way. Number one, you have 5 or 6 or probably maybe dozens of companies spending an insane amount of money on building out this infrastructure.
And by the way, the word insane doesn't actually represent the insanity of the amount of money we're talking about.
Let's pin this for a second because I have an example. I want to talk about this. Let's come back to insane separately because
All right.
I have a case study. I have a case study for you.
All right.
Yeah. Okay. But we're saying Mark Zuckerberg talks about how for Facebook or Meta, it's existential. And that basically it doesn't matter if they overspend $100 billion or $200 billion, because if they don't succeed, they're toast. The problem is when everybody behaves that way, suddenly you're going to have overcapacity. And overcapacity means you're just going to have too much spending. And therefore, who will benefit from this are you and me, consumers.
Yeah.
And a lot of capital will be misallocated. Now, I want to do something interesting. I want to combine 2 analogies together, additional analogies. Okay. I want to talk about Oracle and the Oracle and the OpenAI deal, and I want to talk about Andrew Sorkin's 1929 book.
Yeah.
And I'm going to combine it in an interesting way, I think. So let's talk about Larry Ellison. Larry Ellison now is, I think, if either he's the richest person in the world or one of the richest. Okay, and so Oracle today is worth $800 billion. And the value of the company went up by a few $100 billion where Oracle announced this deal with OpenAI, where by 2030, roughly, they committed to spend $300 billion. This is the insanity that you're referring to.
Oh, yeah.
And OpenAI is going to pay them somewhere between $30 and $60 billion a year, something like this. Okay. And so I was thinking, wow, this is interesting, but how could Oracle do this? So I looked at their financials. So Andrew, okay, Oracle last year generated, and I'm going to be generous when I say this, about $15 billion, 1.5 of free cash flows. Oracle has more debt than they have cash. In other words, they have literally, I think, let's just make the numbers round, $100 billion of debt and maybe $10 or $20 billion of cash.
So let's say they're leveraged.
They're levered. They already have, so they have $15 billion of cash flows and they have $80 billion of debt, net debt, after you take out all the cash. So they basically going to have to borrow $300 billion because their cash flows are not good enough. Like there's not enough money to.
You're talking about OpenAI.
To do this, yes.
Right.
But then you should tell me, Vitaliy, Larry Ellison is brilliant. He built an insane company. That's an incredible company. He must know what he's doing. And listen, the part of me wants to believe that's true. And then I'm going to tell you a story from. There was this. I'm early into Andrew Sorkin's book, but there is a character there that you may be familiar with. His name is William C. Durant. Mm-hmm. He was the guy who started General Motors. He basically, I think if I remember right, he built Buick, merged with other companies,
Yep.
and built General Motors. Then he was kicked out from General Motors. Then he co-founded Chevrolet, and then merged again with General Motors and took over General Motors again. So you would argue this guy is like Larry Ellison, like in a sense, brilliant guy, started like a company that's still around today. I mean, after a few bankruptcies, but that's not his fault. But so he built General Motors. But what was interesting, and this is what blew me away, he lost his shirt in 1929 bubble through complete speculation. He thought this time was different, and he blew all his wealth. And I actually looked it up because I'm not that far into the book, but he died in 1947, complete destitute, managing bowling alley.
Oh,
It's somewhere in the Midwest.
wow.
So I'm not saying Larry Ellison is destined to manage a bowling alley, but what I'm saying is that just because people are brilliant does not mean that every decision they make is gonna turn out well. In fact, I would argue that a lot of times the more successful people are, the more arrogant they become. They feel like they can walk on the water, and the more likely they are to blow up.
Yep.
And so Larry Ellison, the reason I'm kind of focusing on Larry Ellison, because there's a lot of Larry Ellisons out there right now.
But here's the deal. I mean, we own the stock, and I was very pleased. With the movement of the stock after the fact, right?
Okay.
But the problem is, I said at the time when it went up, which is what that was in when was that?
A month ago, so yeah.
So it was September. So it went up to $323. Currently trading. So that's about a month ago. So it's currently trading at give or take 256, right? So that's like $75. That's a good hunk on the downside from where it was. It's not all the way down to where it was. It started out that day before it got pushed to 248. It's at 256. It's only $15 higher right now.
Uh-huh.
That brought in what I thought was one of those jump the shark moments. If you're familiar with that phrase, and Fonzie jumping the sharks in Happy Days, it was like, wait a second, like you said. You're committing to do a few $100 billion in money you don't even have and hoping this is going to all work out. Somehow you're going to come up with this cash. And OpenAI and Oracle, that's not the only deal that OpenAI put forth. There was a ton of other ones. There's like $1 trillion they committed of money they don't have. By the way, they pushed the valuation and the market cap of companies dramatically higher.
Well, I think that's if you look at all the deals, so there is a lot of kind of incest and circularity in deal making that has happened over the last couple of months.
Right.
But what's interesting about this, in the middle of all that, the domino that's going to topple everything is OpenAI, right? Because it's basically OpenAI has to succeed for all these deals to work out.
Correct.
And their success has to be so astronomical.
Yep.
And now this is where Oracle has changed the game. Until Oracle, most of these deals were done by just Facebook kind of drawing its cash flows. Google is kind of drawing it, kind of spending the money they had. Oracle deal basically put us into this new phase of spending where it's debt financed. Now, if everybody looks at it as an arm race and the prize is very big, there is absolutely no reason why Facebook and everybody else are not going to start borrowing hundreds of billions of dollars. So this party can, I don't know when this party is going to end. What I have learned through my experience is that, like, I'm willing to look like a moron for a while, but my goal when it comes to money management, my goal is not to blow up.
Of course.
So I feel like I don't have to play this game. there's so many other companies I can look at and analyze. And this was kind of the point of my article about this, is that I don't have to play this, even though everybody talks about it. And, and it's entertaining. It's entertaining, but it doesn't mean I need to own any of those companies. And I think it's going to end in tears like it has in the past. By the way, we had bubbles like this in the past. And like in the 1800s, there was a huge railroad bubble in Europe. And the railroads were going to change the world, and they have changed the world, right? Except investors lost, most of their money who invest in railroads. So this is kind of my thoughts. This is my thoughts about investing in today's environment, I guess.
Well, I mean, I think there's a reality check that has to happen, and the reality check that has to happen is the acknowledgement that not every company is going to keep on growing at these levels. And I think that happened last week with Facebook, Meta, where they said, "Hey, we're going to be spending this much," and other companies. I mean, Amazon had a great earnings number last week. Bottom line, by the way, a little surprise number, a surprise announcement. You mentioned Andrew Ross Sorkin. We have him scheduled sometime in December. We have 2 dates actually, and he hasn't been on the show in a number of years, but I thought it was a good time to get him on. And I guess my copy of my book's in the mail somewhere.
Can I tell you, this book is so good, and I rarely endorse books like this, but that book is so good because I think he gives you such a great insight into that time period and into human behavior. And you realize, I mean, there are things like, well, one thing after you read through this book, one thing you realize that how crooked the stock market was then, and how you can't even, sometimes you can't even draw parallels because by today, if most of the participants in the stock market then did those things today, they would have been in jail already.
Yeah.
Certain 10 lifetimes. So just the regulations were different, and it was Wild West. But at the same time, what hasn't changed is just human behavior, the fear and greed. It's
never going to change. It's never going to change.
It's never going to change.
Let's talk about valuations and try to make some sense out of things. You mentioned, you're willing to be wrong for a while, but in the end, be right. That's the hope, right? You're the long term. You're willing to take short-term pain for long-term gain, or better said, you don't need to follow the crowd necessarily just to follow the crowd. You're going to use what is I'm putting words in your mouth, but good, solid analysis to get to the point, being much more comfortable than having to worry about having a company. Like, for example, we owned a company for clients, 2 of the SMR, the small modular reactor companies, right? Uh-huh. They had no product, no nothing, but we saw that was going to be a big boom in that opportunity in theory, right? Hundreds and hundreds of % we made on the stocks this year. Sold them out last week. But the point is, I was uncomfortable the whole time owning them because even though they were running up like crazy, I'm like, there's going to be, unless they come up with a product and actually a sale and actually they implement it and a regulatory approval, I'm sitting out here just hoping and praying.
Yeah, no, I think and you probably, and I know you don't have a portfolio of them.
Right. No, there's only a few.
That's exactly right. So I think if I look at today's valuation, the market is quite expensive. I mean, the best way to describe it is this way. A couple of things. Number one, 60% of my portfolio today is outside of the United States.
Mm-hmm.
And by the way, I'm not getting much joy from that because how difficult it is to buy foreign stocks and how much more difficult it is operationally.
Yeah.
So we're going through these pains because we can't find enough high quality companies that are undervalued in the United States.
Right.
That's point number one. Point number two, our new accounts today are probably maybe 50% invested. Even with foreign investments, we cannot find enough companies that are, that are where I can say it's a high quality business that's undervalued. The market is probably one of the highest valuations over the last 100 years. I used to know the statistics, and I used to be able to tell you how expensive it is. I gave up.
Well, you look at the CAPE ratio, it's higher than it was back in 2020.
Exactly. And I wrote, and I wrote 2 books on this subject, and it's kind of that, and you and I discussed it so many times. The bottom line is this: your future returns are a function of how much you pay for stocks.
Right. That's great.
If you can have a great company, but if you overpay for it, your future return is going to be mediocre. It's just that simple. And today, if you look at the stock market, like the overall, it's very expensive. So if you own an average stock, the returns are going to be mediocre going forward. Also, and this is kind of interesting, what we also like, there is a tale of 2 economies. There is a tale of AI economy and the kind of large company economy and everything else.
Right.
And I think this is kind of under the surface, that's what's going on, because most of the growth in the economy today has happened because of AI. It's kind of like our Y2K version of kind of.
Well, NVIDIA is an 8 or 9% position in the S&P 500.
Exactly.
8 or 9%, $5 trillion company. It sneezes and the whole market goes crazy either direction.
Exactly.
So, and by the way, that I find to be a fallacy in the construction of indices that allows for these companies to get so large, because you can't help it. You can't stop it. Because if you have market cap, it's just what it does. And that the larger market cap begets larger buying, begets larger market cap, begets more, and it goes. It's a cycle that you cannot break, because, and by the way, this happens on the up and the downside, right?
That's right.
So things roll over. Why? And this is a reason that many of the players out there are so desperate to keep things up, because this thing rolls over. It rolls over the whole indice.
So it's kind of interesting. This kind of parallel to 1929. In the first 20% of the book, like most of the conversation is talking about how to keep the stock prices high.
Yeah.
This is the narrative of the first 20% of the book.
Right.
It's just like everybody's trying to figure out. To me, it's like how to try to fight the gravity. Like you can fight it for so long, at some point it's still going to happen.
Right.
So if you own overvalued assets, unless you get off, you're going to lose money, or you're going to have miserable returns.
But the difference between then and now is a big difference. I think a gigantic difference is now you have players that have time frames that are infinity. You have players like sovereign wealth funds that are actively buying, like the Norway. Look at them. Mm-hmm. Look at the sovereign wealth fund of the U.S., which, by the way, is not really in existence. But what do we do instead? We just take positions somehow magically in companies at low prices. Yeah. Or you have NVIDIA, who puts $1 billion into Nokia, right? Who puts $1 billion into this fund. Or you have, all of a sudden, the United States of America buying 2 supercomputers built by AMD for $500 million each.
God.
So how does that work? $500 million for a computer. No, it's not your off-the-shelf laptop.
What? Actually, Doug, I'll be honest. That is 2 years ago. Because $500 million now is nothing.
No, for a computer? For one computer?
Yeah. Hey, listen, $300 billion.
I guess.
No, but you're right. Can you imagine half a billion dollars for just incredible.
It's got to be I want that lighting up. I want to have great speakers on that laptop for that kind of money. Yeah. No, but seriously, we have a whole different level of money that's being pushed in. We used to laugh and we used to scoff at Japan that was actively buying. Oh my God, the Bank of Japan was actively buying inside their market. And we would look at China and we'd say, there's the SOEs, the state-owned enterprises. What an awful situation. How unfair that they have the Chinese government propping up, helping, creating a much better scenario for them from a competitive standpoint. And now we're doing the same thing. The money that is flowing in from all of this is nonstop and unstoppable. Not to mention the 401k plans and all the normal mechanics of the market. But I think there's something to be said about the fact that there's a lot of pensions, people living longer, they have to change their structure. They used to have just bonds and they've changed that dramatically. There's major funds at colleges, endowments There's a lot of money out there that just says, you know what? We have a really long time, 10, 15, 20-year time horizon, and their time horizon, they don't flinch.
Can I give you counter argument to this? And this counter argument, I think I forget who I forget who said it, but I think that was an interesting insight. So most of these funds today don't own equities; they own private equity. And when I say most, like let's say like 80-20, roughly. I don't know, like maybe 80% private equity, 20% equities, something like this. But what's interesting, if you're gonna have enrollments start declining, then they're gonna have to start digging into start selling their private. Their time horizons may end up being not as long as people thought they were.
Mm-hmm.
Okay, and so there will be pressure on private equity firms because private equities, the magic of private equity is that they're not mark to market 5,000 times a day. And when they start marketing to market, they may realize that these businesses are worth less than those endowments thought they were. That's number one. Number two, what was interesting about the 1929 crash, what really made things a lot worse, and actually I would argue what really has created the collapse itself is debt, is leverage.
Yep.
And I was watching an interview with Paul Tudor Jones, who's basically said that, well, if you look at today's margin debt and you combine it with leveraged ETFs, so this is important. It's just, so not just to make it apples to apples, we're not that much different from 100 years ago. So there is a lot of leverage in the system.
We hit a peak leverage. We hit the margin debt at brokerage firms hit a all-time high like just 2 weeks ago.
Okay. Well, and that number probably understates the true leverage, right? Because of the leverage.
The extra. Well, how about all the extra options that are out there, which can expire over time, so that's fine. And those are expected. But yeah, the leveraged ETFs and other leverage things. You talk about private equity, by the way, and that has a theoretical indefinite time horizon, right? But I got to tell you something. It's all fine as long as the marks look good.
Exactly.
And they could keep the marks looking good because nobody really cares, because nobody knows what's going on underneath everything. But all of a sudden you get those marks looking bad. And by the way, I don't know if you ever deal with like interval funds where you're locked in for a period of time. So it's kind of like a mutual fund that has some of the characteristics of either private equity or hedge funds, where they have a gateway where you can get in or out over only on a monthly, quarterly basis, let's say. And we have a few of those for clients that we inherited, and we've been trying for a while to get out. And these are the good times right now, right? These are generally where things are liquid. There's no problems. And what's interesting is that with regard to the request that we put in a couple of weeks ago, we only got like an 18% allocation for sale. And that's in the good times. In other words, we said we want to sell 100%. They said, no, you can only sell 18. Mm. So it's going to take us another year to get out of this deal.
Oh, God.
So my point, though, is what's really fascinating about all this is that, you have a situation where we have good times. People know this long term, but yet you can't get out. Now, once all of a sudden people have to get out, things change when liquidity is not there.
I think, Andrew, this is kind of my message to your listeners. The time to get paranoid is right now. Is when you have this euphoria and nobody cares about risk. This is when the quality of your decision matters so much.
Mm-hmm.
But I'm not saying to get out of the market. I'm not saying none of this stuff. What I'm saying is you basically ask yourself a question. I want a portfolio of stocks. And if the market, like this is Warren Buffett's actually kind of approach to this, and this is his definition of quality. If the market was closed for 10 years and I could not sell them, would I still want to own what I own today? And I think this is really this is how, like, when I look at portfolio construction, that's what I think about.
Yeah, smart. That's the ultimate.
Yeah.
That's the ultimate feat, to the fire.
That's right.
Yeah. So, I mean, we're going to go through a lot of different cycles. But, it was funny. Just recently, I was driving down the road. I'm thinking, what other things can happen from a financial engineering standpoint? Like, we see the vendor financing, we see the circular financing, the things with OpenAI, the money that goes in from governments, the NVIDIA that's buying this company or infusing money there. I'm thinking to myself just the other day, I'm thinking, we haven't seen stock splits recently. I wonder, if one company is going to come out with a stock split. And then all of a sudden, remember where that was a big thing where stock splits happened and companies' stocks went crazy. And we just saw the news that Netflix is doing a 10-for-1.
Oh, really?
And I find it fascinating that we go through these cycles of whether it's financial engineering or you want to call it shareholder beneficial transactions. But it's kind of interesting how this whole thing flows. The point is, though, what I like about what you do is you separate the noise from the facts. You put aside some of these things and really come up with what is a company, like you said, that you would own for 10 years without having to even look at it, theoretically.
Yeah. Well, I think the beauty of what, and you do kind of similar, I guess, is that I own individual businesses. Like, they happen to be publicly traded. And therefore, when you analyze these companies, I have a time horizon, of decades, 5 or 10 years at least. And therefore, you start looking at everything going on in the market through the lens of 5 or 10 years.
Right.
And a lot of things just kind of, fall through and say, I'm not interested in that.
I think it's smart. I think it's great. Vitaliy Katsenelson, always appreciate you spending time with us.
Thank you so much. You're so good at this.
Oh, you always say that. Thank you. You're so nice.
I always enjoy it. Thank you so
nice.
much.
You're so nice. Make sure to go over to the website, thedisciplinedinvestor.com. We have links on how to get his books and his writings and information about IMA, and all the things are right there over on episode number 945 of thedisciplinedinvestor.com. Thanks, Vitaliy. Talk to you.
Oh, Andrew, thank you so much.
Right.
Thank you.
Bye. Another great episode, another great guest. I want to thank everybody for joining me this time, every time on the Disciplined Investor podcast. Don't forget to listen to DH Unplugged, which is happening each and every week. We record myself and John C. Dvorak on Tuesdays, and we talk about all the great stuff that's happening in the news. We'll be dissecting what's going on with the Amazon numbers, the Netflix 10-for-1 stock split, and all the other things that are going on with regard to not only companies, but the economics, the politics, the markets, all that we talk about every Tuesday. Thanks for joining me this week and every week, and I'll see you around real soon. This podcast is intended for informational purposes only and does not constitute personalized investment advice. Investing involves risk, including the possible loss of principal, and past performance is not indicative of future results. The views and opinions expressed are those of the host and any guests and may not necessarily reflect those of Horowitz & Company, Inc., an investment advisor registered with the U.S. Securities and Exchange Commission. Registration with the SEC does not imply a certain level of training or skill. Advisory services are only offered to a client or prospective clients where Horowitz & Company is properly registered or is excluded from registration requirements. Any mention of third-party companies, products, or services is provided for informational purposes only and does not constitute an endorsement. Hypothetical scenarios or forward-looking statements are for illustrative purposes and should not be viewed as guarantees. Content is intended for U.S. residents only and may not be applicable in other jurisdictions. Listeners should consult a qualified financial advisor before making any investment decisions. Please visit our website for additional information, disclosures, as well as a copy of our Form CRS. Advertisements are not related to the host or affiliates and are not considered recommendations by the host of the show or any affiliates of Horowitz.